But let me now welcome on board Kunal as well as Naresh and Shibani Sarkar Korean as well in just a short while from now and find out what they're making of the market move. Kunal, hi afternoon. Closing this historic week in a sedate way. Next week, you think we'll back to the winning streak?
Well, I think it's a bit of a profit booking on the indices. I think there's not much of a change in terms of the way in which the markets have approached. I think it's been a fabulous week for the index. We've gained substantially for both the indices, Nifty and Bank Nifty. And I think it could be a good time to try and take some chips off the table. But the good part about the market so far is that even in the last half an hour, when the selling was getting a bit more aggravated, you still had large cap names like L&T, ICICI Bank, etc., which are trying to come back to their intraday highs. So that itself indicates that it's not that everything has been going through a corrective phase. The markets are going through a churn, and hopefully this time around the large caps could make a stronger comeback.
Okay, large caps are making a strong comeback, and today, of course, the comeback has been from the IT pack. Take a look at that 1.5% move. HCL Tech, LTI Mindtree, Persistent, they're all doing well for themselves, and even for the week gone by, the IT index has been up around 2.3%. Naresh, what's your view on IT and the banking index now? 5% gain this week?
So IT as an index has almost close to the Nifty IT sector index is close to a breakout, and if this sustains, we could see some more follow-up action. So stock-specific action has been very good. So if you look at a HCL Tech, you have it at an all-time high. You're seeing a TCS come to a 52-week high. You're seeing a LTI Mindtree. So a bunch of names in IT are showing strong momentum. So this could possibly mean there is another 3-5% upside, at least on the large cap names, and maybe a 8 to 10% upside in some of these names. So IT as a sector could see some follow-up action over the next week.
Okay, IT could see perhaps some more follow through come by next week as well. Decent amount of move is what you've seen there. Still haven't resurrected ourselves from the sugar moves. Kunal, any glimmer of hope there, or you think there's further downside before things begin to look up?
In fact, for the first time, I was actually seeing a good amount of short built up into these, the sugar, specifically for the likes of Balrampur Chini, where right from the time when the stock opened, I think it was at 410 odd levels. The stock saw a mild bit of bounce back, but then it got sold immediately. And even in the mid part of the session, when the markets were going through a bit of a chop and churn, the stock continued to remain under pressure. And now that I think it's come back towards 390 odd levels or sub 390 mark on an intraday basis. So that itself indicates that there is more pressure into the stock price. I would be a bit wary of building on long positions over here. And the bigger concern now for Balrampur Chini is that the stock has fallen below the 200-day moving average. So maybe another couple of days of closing below those levels, we could see the selling a bit more aggravated.
And take a look at Praj Industries as well. That's quite a bit of fall on that one, almost a 10 to 11% fall. And this week itself hasn't been too sweet for the sugar and ethanol place. So we are seeing a bit of a bitter pill being taken by some these names as well. But Shibani Sarkar Korean is also with us. Shibani, what's your view on the market? It's been quite a meteoric rise that we have seen in the index over the last 7 to 10 trading sessions. Do you expect this to continue for the rest of the year and see that Santa Claus rally strengthening, or it's time to probably hit a pause and recalibrate?
Yeah, hi, good afternoon. So I think the stars have clearly aligned for equity markets. So post the state election verdict, it is very clear in terms of policy continuity, especially post the central elections. And therefore, the markets have clearly cheered that as well. But apart from that, I think what is really a standout for our markets has been growth. From a GDP growth perspective, we've seen that numbers have been revised upwards, and therefore India now continues to be among the fastest growing regions in the emerging market pack. The second most important factor for the market, apart from the policy stability and continuity of the government, is the fact corporate earnings has been holding up extremely well and has been very, very broad-based across sectors. And therefore, for FY24 and 25, it is likely that we will possibly meet consensus estimates or maybe see some upsides there. So I think all these factors have been playing out for markets. But as you rightly said, when we look at markets, we can't ignore valuations. Our belief is that from a market perspective, large cap valuations continue to be fairly reasonable in line with long-term averages. We've seen very steady earnings growth for the large cap pack as a whole, which has not reflected in terms of the multiple re-rating as we have seen in case of mid and small caps. Our belief is that both absolute and relative valuations for the mid and the small cap segment, specifically the small cap segment, is above long-term averages. And therefore, at this point in time, while we remain structurally positive on the market, our preference has been for large caps over mid and small caps, and that preference continues.
Okay, that preference stays right now. That's the overall construct of the market. Shivani, have to discuss what you made of the policy takeaways as well. You know, especially the growth guidance, the commentary coming in around inflation. What does it all spell for equity markets? And the fact that they're not going to go easy when it comes to, the rate trajectory.
Absolutely. So I think the monetary policy as outlined today is a continuity of the good work that has been done over the past many years. So over the last few years, what we have seen is both fiscal and monetary policy have come together, and that is now reflecting in the fact that our GDP growth continues to remain significantly higher than many other economies and the large economies of the world. And in fact, even RBI has upped their GDP growth guidance. So growth remains strong. From an inflation perspective, inflation has moved into the range that RBI talks about. But I think clearly structurally, RBI would want inflation to move to that core level of 4%. And therefore, that is their target from an inflation stability and financial market stability perspective. Our view is that rates will possibly be at current levels, and therefore it's more of a pause. A lot would also be determined by what the US Fed does, and therefore rates in India from a policy perspective, while may not move higher, but will clearly follow the path that the US Fed takes, and therefore it's likely to be a prolonged pause as of now.
Okay, prolonged pause is what we are expecting in terms of the monetary policy action, but take a look at some of the buzzers as well. It's GMR infrastructure, which is higher by 13%, and IREDA, one of those recent listing, continues to gain ground, so it's 10% higher yet again today. And from the real estate pack, it's Sobha, which is fairly excited, and then Prestige Estate as well. What's your take on real estate right now, Shabani? And would it be prudent to play this directly through the developers, or it's better to go towards building material, home improvement, consumer durables and the likes?
Yeah, so real estate has been one of the key drivers of the entire growth revival that we've seen apart from infrastructure, capital goods, manufacturing. So what has worked and what has changed in terms of the real estate space has been clearly the inventory correction that you have seen in the system. And that has meant that the overall pricing has also come back. Secondly, there has been significant amount of consolidation because of the policy changes that have taken place on the real estate space, which means that the organized larger developers have gained market share, and that bodes well for the listed space. Incrementally, we do believe that real estate demand is likely to remain strong. And therefore, if you look at the data that is coming through in terms of new launches and pre-sales, the data remains strong. But however, the sector has seen a sharp up move, and therefore, from a valuation perspective, one has to be a little selective in terms of the stocks that one chooses in the sector. As you rightly pointed out, one other way of playing the real estate thesis and as a theme is the entire home building and the building materials space. So segments such as cement, tiles, the entire building material pack, including some segments of consumer durables, etc., would possibly be a better way to play the entire real estate thesis, given current valuations in that segment.
Shivani, though, what about the larger infrastructure theme? While, of course, the go-to name here continues to be L&T, but for instance, an airports play like GMR is holding out very, very smartly today. Of course, there's been that sizable block deal as well earlier today. And of course, whole host of ancillaries within this pocket too.
No, absolutely. Our basic thesis has been that the entire manufacturing, industrials, and infrastructure is not just a one-year theme, but it is a multi-year theme. Now, for instance, if you looked at what's been happening over the last few years, growth in the space has been largely led by public capex and government spending. At the margin, given the kind of capacity utilization levels that you're seeing across a few industries, there are signs of pickup in terms of private sector capex. And that is also getting reflected in terms of the order flows that you're seeing and the order booking. Across the space, in fact, even if you looked at the last quarter numbers, order inflows have remained robust. And therefore, what we believe is that the run rate for growth remains extremely high. So segments such as, for instance, the core infrastructure space, defense, railways, water, power, power T&D equipment, airports, all of that remains fairly buoyant from a growth perspective. One has, of course, got to keep valuations in mind. This segment has seen significant run-up in terms of valuations. But valuations aside, as a theme, this is a theme that we believe that will continue to play out, especially now incrementally with some of the private sector capex momentum starting to play out. It will possibly be more visible over the next 12 to 18-month period, but we believe that the tailwinds are clearly there for growth to pan out over the next few years.
So that's a positive view coming in on the infrastructure space. The SIP data is just trickling in, and we understand that the total stands above 17,000 odd crore rupees. So this is the first time that the SIPs have gone past the level of 17,000. Just last month we had seen number very close to that figure, 16,900. So not a big surprise coming in. It was expected to inch higher, and given the momentum that we are seeing in the market, there's still a lot of FOMO feeling that a lot of retail participants have. In fact, Shivani, what would be your advice to people who are having that FOMO feeling? What's the best way to play the market right now?
So I think what we keep telling our investors is that timing the market is extremely difficult. Give time to the market, and therefore have a very disciplined approach in terms of how you invest in equity markets. SIPs clearly is one of the best ways in terms of investing in the markets, which allow you to invest over a long-term period without having the fear of trying to time the market, which is extremely difficult for anyone to do. And therefore, keep in mind your entire asset allocation strategy, keep in mind your investment goals and horizon, and be extremely disciplined. And SIPs continue to be one of the best ways to invest in equity markets.